Draper with Hamish Douglass, the CEO of Magellan Financial Group. Today we're talking about the Quant Easing program, and Hamish, you spoke with Alan Kohler recently about the next biggest risk the world has to face as being what happens when the US stop pumping in so much money into the financial system. Can you talk us through what the Quant Easing program is and what it's doing at the moment, and further that conversation you had with Alan?
Mark, this is an incredibly large question.
Yes, it is. And you've got 3 minutes to answer it.
You've asked, so I'll be quite concise. The quantitative easing program is their stimulus program where the Federal Reserve in the United States of America are buying US bonds, known as Treasury, and actually long-dated mortgage-backed securities that are guaranteed by the US government. And it's purchasing these from the market. And as it purchases these in great quantities, currently $85 billion US per month, it's obviously pushing down the market yields of US government bonds and also US mortgages.
Yeah.
And when it reduces those yields, effectively it's trying to encourage mortgage holders to refinance at lower rates, to put more income into their pockets, to stimulate the economy. But it's like giving people a tax cut.
Yep.
And of course, by lowering interest rates to almost zero in the government market, it's trying to encourage investors to go and do something more risky than placing money just in bonds.
So it's really about artificially keeping interest rates low.
It's artificially keeping interest rates low, and that's the first important message. What the Federal Reserve has done now, it has got a holding of $3 trillion, and it's increasing that holding by $85 billion US a month. By mid next year, they'll be at nearly $4 trillion US dollars. What you have to worry about here is when the economy recovers, and the Fed has said when unemployment gets to 6.5%, and it's actually 7.5% at the moment, when it gets to 6.5%, they say they're going to end this quantitative easing program. So the first thing that's going to happen when they stop buying, if they step out of the market and stop buying $85 billion a month, interest rates will have to go up. It's just a matter of supply and demand. The next issue is that the Federal Reserve, of their $3 trillion, about $1.7 trillion is known as excess banking reserves.
Wow.
So that's really the amount of money that's being created out of thin air. It's cash that's been printed, but it hasn't gone anywhere because the banks haven't lent it out. It's back with the Federal Reserve on deposit. So it actually hasn't been inflationary. There's been no inflation during this period. But if the economy's picking up and people want to build new houses and businesses want to invest, the inclination of banks will be they want to take this money off deposit at the Federal Reserve, this $1.7 trillion, and lend it out because they're only earning 25 basis points. That's 0.25 of 1 percentage point interest rate on that money. That's not a very acceptable rate of return, so the banks would like to lend it out at 4 or 5 or even higher and earn a real spread on that money. We own some banks, we'd like them to lend it out. There's just not the demand until the economy recovers. If that happened in that quantity, it's highly inflationary for the US economy. The Fed's very aware of this. So they believe what they're going to have to do is to effectively not only stop buying bonds, but they're going to have to work out a way of effectively stopping that money getting out in the economy. And this is where the equation starts to become a lot more complex.
Yeah.
If they were to decide they were going to just sell that portfolio at the same time as not buying $85 billion, it's frightening to think where interest rates could go in that environment.
Yes.
Of course, the Fed will do something more nuanced than that, but the problem is what the Fed is saying at the moment, I think goes from the completely ridiculous to the semi-plausible in how they're going to exit this without causing... If the bond rates went up too fast and too quickly, that's a major crash of the bond market. There'll be an enormous loss of value. And if interest rates go up too high, it's going to put a massive fiscal drag on the US economy because they have to pay interest on their government debt.
And as bond rates rise, if they rise too far, it's going to damage the share market as well.
We believe the share market is factoring in about a 5% long-term bond rate at the moment. Of course, they're about 2% at the moment. We think our valuations are around 5%. So if bonds gradually went from 2 to 5, we think the stock market's okay.
Yeah.
But if they went from 2 to 8 or 10, the stock market's not okay. And that's really the question. We think there's a tail risk that could happen. Our central scenario is they kind of go to around 5. over the next few years as this program ends and they have to start selling this portfolio. But it is, as you say, it's a risk. It's a risk that the markets lose confidence in the Fed's ability to get out of this. And there's no precedent in history of this activity being done before. And so it's very sort of, it's a lot of theory about what they can do. We won't know how it actually plays out until it actually happens.
Yes.
And I think people are underestimating the tail risk that it could be much worse than people are thinking it could be at the moment. And that's what we think about a lot as a fund manager. What is the lower probability risks here and how big could they be and what really is a risk for our investors? So we're spending a lot of time thinking about that. We think we've got a little bit of time, by the way. Yes. This isn't this year's issue, but it will start to become a much bigger issue next year, the year after, and people really starting to talk about this.
And so to finish off on it, because I think that's a very good insight as to what the issue is and some of the things to look for, what are a couple of the signposts that investors should be paying attention to as this scenario plays out?
Look, if bond yields really start rising before the Fed starts reversing course here, it may be the markets are starting to get ahead of the Fed. Because if the bond rates are going up and the economy's recovering and the Fed's still buying, what's going to happen when they stop buying, if that's the dynamic? So that would be a warning signal that the market may be ahead of the Federal Reserve. If the economy starts recovering more quickly, the US economy more quickly, and starts picking up pace ahead of people's expectations, as much as you may think that would be good, with this problem sitting out there, it may actually be bad because it may make it harder for them. So there's a number of things we're looking at. And we're really thinking through what the Fed can do, and it will be multifaceted how they get out of this. It won't be one simple policy. There is a lot of debate going on in the Fed. There's some dissension going on in the Fed around this at the moment. I think stopping purchases and slowing them down sooner rather than waiting right to the end would be good news. Right. The stock market probably wouldn't like that in the short term, but if they slow down the purchases in advance of when people are expecting them to do that, although the stock market would drop in the immediate term if they did that because it would be out of line with expectations, it's actually reducing the risk, yes, which is actually good medium-term news.
Yes.
So there's a number of things we're looking at.
Look, it's a very complex issue. We live in a very complicated world. We probably always have. It's just with the level of information, it's much more these days. Thanks for your time today to explain one of the big issues that's coming up in the next couple of years. For more information, just stay tuned to our website, and thanks again, Hamish.
A pleasure, Mark.